This is an interesting change. Unusually for the dismal science of economics, skepticism about this strong 4.1% number giving way to optimism about U.S. growth. While many went into the second quarter number thinking strong growth would be the result of one-off factors, several forecasters emerged as believers that above-trend growth can continue. Exhibit A, J.P. Morgan, in the wake of the number, boosting its third quarter growth forecast to 3.5% from a middling 2.5% in a completely clinical line. They said the composition of growth had favorable forward-looking implications. That's an economist being excited, Mike Ferroli there. Now, two parts of the Friday report are fueling the bull case. First, inventories were negative. They're expected to bounce back this quarter. Second, government spending was not as high as some expected, so there's more federal spending to come. All of that comes along with strong underlying numbers for the consumer and business investment that economists think are fueled by the tax cuts and deregulation. Over at HFE, they say Q2 GDP data may have been exaggerated, but trend in growth has likely picked up significantly. And there is more economic data of import to come this week that will shape the outlook. Here we go. June income and spending. It's going to set the level for third quarter comparisons. And the BOJ decision tonight that I'll let Michelle tell you what they're going to do, because I think a lot of people are confused and confounded by what's going to happen there. ADP on Wednesday gives us a curtain raiser on the Friday jobs report. ISM manufacturing. The Fed statement should set the stage for a September rate hike, and vehicle sales the first data for the third quarter. Jobless claims, Bank of England expected to raise by a quarter point. Jobs report on Friday, and the trade deficit along with ISM services. Scott?
You want to react to the Treasury Secretary over the weekend saying 3% sustainable for 4 to 5 years?
Again, I think that's a little bit overstated, but I don't think it's out of the realm of possibilities. I mean, look, there's a political angle on this and there's an economic angle. As I've said a lot, I think raising underlying potential growth from what is 1.8 to somewhere between 2.5 and 3 is possible if you get a sustained capital investment. My big question, Scott, is about the consumer. What you had, if you look at the breakdown of GDP, you had this 4% number. I do not know if that is a one-off thing from the tax cut. There are those the probabilities for the Fed right there. We can talk about that in a second. But
that's one heck of a prolonged cycle if Mnuchin is right.
It is.
Yep.
It is. And it would be a very big deal for revenue. It would be a very big deal for U.S. economic growth, and a very big deal for people's lives if we can get this upward shift in growth. The trouble is you cannot tell. There's two things that go into growth. We've talked about this a bunch of times. Productivity and population growth. You can sort of estimate population growth. Nobody knows the productivity cycle. The idea being if you do capital investment, perhaps you can have an upward shift in productivity. We'll see about that. But nobody understands why the electric engine was invented when it was invented, or turbines, or any of the great inventions, or the internet, why it happened when it happens. And I don't think anybody ever predicted it. The best you can do is kind of game out the effects of these inventions. But if there's low-hanging fruit or even medium-hanging fruit of productivity technology out there, we can have an upward shift in productivity, because I'm pretty sure we're not going to do so good on the population front the way things are going on, immigration and demographics.